Hey everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeezes. Today, we're looking at a company that's been lighting up our screeners with some truly eye-watering cost-to-borrow fees, placing it firmly in our spotlight. We're talking about 707 Cayman Holdings Limited, trading under the ticker JEM. This is a highly specific situation, and we're going to break down exactly why JEM is showing up as a hard-to-borrow stock right now. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, who exactly is JEM? 707 Cayman Holdings Limited operates in the consumer cyclical/apparel retail sector. They're involved in selling and distributing fashion apparel products like denim, athleisure, sweaters, and outerwear across Hong Kong, Western Europe, North America, and other international markets. With a current market cap of just $2.04 million, JEM is a microcap company, which often means lower liquidity and higher volatility. Let's look at some recent price action. Today, JEM is down 18.18%. Over the last 5 trading days, it's seen a significant drop of 65.99%, and looking at the last 30 days, it's down 10.0%. Volume-wise, JEM traded 4,545,300 shares today, which is about 0.5 times its 30-day average volume of 8,364,503 shares. These are important context points as we discuss its hard-to-borrow status. What is cost to borrow and why it matters? Before we get further into JEM specific numbers, let's quickly define what cost to borrow or CTB really means. When an investor wants to short a stock, they first need to borrow shares from someone who owns them. The cost to borrow is the annualized interest rate or fee that the short seller pays to borrow those shares. Think of it like a rental fee. To a simple chart of CTB explanation, a high cost to borrow indicates strong demand to short a stock or a very limited supply of shares available to borrow. Why can it exceed 100% annually? Because it's a daily rate reflecting the immediate supply and demand dynamics in the borrowing market. If a stock is incredibly scarce to borrow, the daily fee can spike dramatically, leading to the seemingly impossible annualized rates. Why the stock is hard to borrow right now. Now, let's talk about JEM specifically. Why is 707 Cayman Holdings Limited flashing on our hard-to-borrow screener? The numbers speak for themselves. JEM currently has an astonishing annualized cost-to-borrow fee of 892.2%. To chart JEM's CTB spike. To put that into perspective, most stocks have a CTB in the low single digits. Even more critically, this CTB has seen incredible momentum, increasing by a staggering 732 percentage points over just the last 5 trading days. This isn't a gradual climb, it's a vertical spike. And here's the kicker: there are only 6,000 shares of JEM currently available to borrow. Showgate 6,000 shares available, while JEM estimated float is unknown. Having only 6,000 shares available to borrow, coupled with a nearly 900% CTB, signals an extreme scarcity of shares for short sellers. It suggests that finding shares of this apparel retail company to short is incredibly difficult and expensive right now. Squeeze mechanics explained. So, what does it mean when a stock like JEM is hard to borrow with such a high CTB? It sets the stage for what's known as a short squeeze. A short squeeze happens when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their losses. This covering demand, where they're forced to buy shares, can then drive the price even higher, creating a snowball effect. In the case of JEM, with only 6,000 shares currently available to borrow and the sky-high 892.2% CTB, short sellers are under immense pressure. Every day they remain short, they are paying a hefty fee. If the stock price starts to rise, their losses mount quickly and they'll be scrambling to cover. However, it's crucial to understand that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have incredibly strong conviction that the stock, in this case 707 Cayman Holdings Limited, is headed lower, and they are willing to pay a premium to maintain their bearish bet. Especially considering JEM recent -65.99% drop over 5 days, shorts might be feeling validated for now. Dilution risk check. One of the biggest threats to a short squeeze thesis, even with high cost to borrow, is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide easy cover for short sellers, negating the scarcity that helps drive a squeeze. When short sellers can readily find shares to buy back, the squeeze pressure is relieved. For JEM, our dilution risk check shows good news on this front. We found no recent dilutive SEC filings such as -1, -3, or 424B in the last 90 days. We also found no recent reverse split for JEM in our look-back window. This means the existing share structure for 707 Cayman Holdings Limited appears stable and isn't being immediately threatened by new share offerings that could flood the market. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For JEM, if you're watching this situation, keep an eye on a few key metrics. First, continue to monitor the shares available to borrow if that 6,000 number drops even lower, or if the CTB continues to climb from its already extreme 892.2%, it further increases the pressure. Second, look for a significant increase in buying volume for 707 Cayman Holdings Limited that pushes the price up. Currently, JEM relative volume is only 0.5x its average, meaning it's trading below average. A genuine squeeze typically requires an influx of buying pressure. Given JEM's significant recent downturn of over 65% in 5 days, any signs of a reversal could be interesting, but volume confirmation would be key. In summary, JEM, or 707 Cayman Holdings Limited, presents a very unique hard-to-borrow scenario in the consumer cyclical/apparel retail sector. With an astronomical 892.2% cost to borrow and only 6,000 shares available to short, it's definitely a stock that fits the criteria for extreme short interest dynamics. The absence of recent dilution risk is a positive, but remember, a high CTB is just one piece of the puzzle. It tells you there's high demand to short or low supply to borrow, but it doesn't guarantee a squeeze. Always conduct your own thorough research. If you found this breakdown helpful, please hit that like button, subscribe for more deep dives, and let us know in the comments what hard to borrow stocks you're watching. We'll see you in the next one.